one you're looking for the offer?
Alrighty, we are back in business. Sorry, just bring a little bit of a chart in. Reason being, we've just been watching the Bund, those of us here, and the Bund has just dropped out of the sky very, very, very quick. And this is a classic example, right? You look around, and we'll go and look at a couple of other things in a minute. You look around at what the Bund's done, what the T-note's done. And if you want any more info on it, you kind of look around and go, okay, well, what about anything else? What's the S&P done? Nothing. What's gold done? Not a great deal of anything either. And you kind of look at that and think, well, what was that all about in the Bund? I don't know. That's as simple as answer as I've got. And sometimes that is it. I don't think there is a straightforward answer on that. I don't see why it suddenly needed to fall out of the sky there. It just did. But technically, and we'll come on to a couple of these bits in a minute. Excuse me, my mouse, incidentally, is, I think, on its last legs. Yeah, it technically, the Bund is trading really, really nicely. And I think it's perhaps, if nothing else, it is just that. It is doing what you would want it to do, technically, at the moment. For those who don't look at the Bund all that much. Oh, mouse, come on. No, I think he's... Right, apologies, I might have to get a new mouse because that one looks very dead. So give me a moment, otherwise I'm not going to be able to move anything on the screen. Thank you, mate. Mike's heard me. Well, I've got a pen, so I can try and illustrate this with the magic of profile. But what the Bund has done so far today, starts off the day quiet, drives up. This was the Russia ICBM comment. I'll talk about that in a minute. And then it balances here. We trade up. This is, I was talking to the guys in here about this. I'd got the top of a value area from over here coming in at 59 as a reasonable level. We'd got the morning high at around about 50. And really, once you'd had this pullback, which establishes the low. So this is me talking about trading after this point. Every time you came back down to this area, which was also a previous day's high. So it's quite an easy trade to structure. You've got the previous day's high. Yeah, that mouse just died. You've got the previous day's high. You've got this whole little area here. Anything that comes back down there, you could look at as a buy to take it back up to somewhere in this little range up here. Nice one. Is it going to work?
Yeah.
Whee, look at that. And the Bund effectively made your life really, really easy. Sometimes markets are almost too technical for their own good and you don't really believe it's actually going to work that well. We actually had this discussion about almost a distrust of this actually going back up again when it's trading here. This leans back to a point that I made the other day about looking at a market from the point of view of if something looks like it's working, play it until it doesn't work, rather than try and predict when it's not going to work. If you play this until it doesn't work, you get to a point and finally, you lose some money on it. That's fine. But if the rest of the day, this never escapes this range, you'll get to the end of the day and okay, maybe at the end of the day, you're long at 30 and it's trading 33 and you have to give it up for a 3-tick winner. You don't lose at all day long. And it just goes over and over and over and over. We saw the move up to 59 on the jobless. It sat up there, it sat, and then gave it up in a pretty impressive technical fashion, I'd say. Yeah, the drop on that was very quick for a technical. But it's dropped down. 40 is the kind of mid-range area now. It's sort of the middle of this little zone here. But to see it go 30 again wouldn't be a surprise. I'd look at this now. I think you perhaps look at this and think, well, it could get stuck at 50. This could be the one attempt out of the range that fails, creates the tail on the day, creates that taper of volume, and then just rotates back down. In terms of debrief of yesterday, we'll do that tomorrow. And I'll sort of structure it how I'd actually try and put a debrief together. Of a day like that, rather than just put my charts back, rather than me just talk about it now. But what I think is a great takeaway from yesterday is that you don't need to have done everything first thing. Yeah, that first move down in the S&P yesterday was pretty spectacular, but you didn't need to be if you weren't part of it, there was a huge amount left in the day. Whenever you get a day like that, and I think by this point, when it starts to bounce, it was reasonably clear what the day was going to look like at the end of the day. You were going to end up with this large initial balance, normal type day, which until the very, very end, which I'm not quite sure what that run up in the last, well, you're literally going into the last 20 minutes is about. If you take that away, this is a standard normal day. So you drop down. Because it's done a lot to start with, you've still got a lot of space to move within as the day goes on. So there's then opportunity. So don't feel you've got to do it all to start with. Main thing, if you don't know why it's doing this and you can't work out what's going on, give it up. Once it got through, I think 15s and 08s, I think that came to the point that if you've been trying to buy the drop on that, you have to go, I don't know what's going on at the minute. If you can do that and just take yourself away from the situation, go, I don't know what's going on, but I've got 6 hours left of trading today, you save yourself digging yourself a hole that you can't get out of. It will settle down. It won't drop like that all day long. I'm struggling to think of an example where, in fact, I don't think I've ever seen the S&P start like that and just do that hour after hour after hour. It just doesn't happen.
Do you have days where it does that, consolidates, and then can still keep going?
Yeah, you can get those. They're not particularly common, but I've seen bigger range days. I've seen much bigger initial balance days than that. But you don't see a massive IB followed by another hourly candle, the same and the same and the same and the same relentlessly.
That's when you get the limit down.
Well, you just don't see it, because what you'll get is, rather than that, in a more volatile period, rather than this be 60 handles, it'll be 150. And then it will do this in a 100 handle range. But it won't just go 60, 60, 60, 60. It's not volatile enough to do that. And if it is more volatile, it will just do the whole lot in one anyway. So you never get that consistency. So the point there being, if you've lost what's going on here, you've missed it, well, let it settle down, because it's going to give you another chance. The other thing is, when it starts bouncing back, take your time on the bounce. It's, again, one of these things. You're better off to let it bounce, move on to a shorter time frame, and then look at, okay, at what point is it now showing you it is going down, rather than letting it bounce and try and sell all the levels back up. Because you could end up in a situation where you've tried to buy it all the way down, sell it all the way back up, and half an hour after the IB finishes, you're stopped out because you've got too involved in it. And if it ever runs away from you and runs away from your idea, you're better off to just step back and essentially just leave it, let it settle down, and then work out what it wants to do. So I'm just watching the bund down here again, coming down to 30. We'll see on that bund at the minute. If it gets down to 30, whether we can cut and reverse it down there. So from the short of 58, that's the play. So we'll see on that one. Right. Interesting.
I mean, if you really want to be bullish, you want to see it fully vaulted up, not even come that low.
Yeah, but why would you be bullish bund on a day that is clearly telling you one thing? It has no direction today. It was bullish for a little period of time, and now it's not. So view it like that. Right, real quick, we did the whole sort of detailed prep yesterday. Once you've done that a few times, you'll often find the case that you can answer a lot of these questions and your prep is less detailed and more sort of quick fire. Just simply because, well, you kind of know what you're trying to ask yourself and know what you're trying to find out. Right, yesterday, Bren, real quick, this was the NVIDIA earnings. Now, I've had one of these before where NVIDIA earnings has come out. Remember, it was expected at 74 cents. It comes out at 78. That's better. EBIT comes in slightly higher as well by about 45. Revenue is higher. Everything looks better. Adjusted EPS is 0.81. So it's all looking good. Now, I've had these ones before and people go, well, why has it gone down? I don't know. To be quite honest, I don't know why that's gone down. It's basically washed out the range. I am of the view with NVIDIA increasingly that if you kind of just stepped away from it, went pure technical and essentially just faded whatever happened, it comes back.
Is that NVIDIA stock?
No, that's S&P. So that was the move. That's a 1 minute on the S&P. So that's 59.41 to 59.11. So 30 handles in a minute and then bounces back. I've seen bigger ones, but broadly it does that. It goes down, it goes all the way back, or it goes up and it goes all the way down. Whichever way it goes, it seems to come back. my view on it is you could almost just treat this technically and just play it like that rather than trying to do it a different way. That's my personal view on that. So we've had that. What we've seen since then is equities just continue to drift higher and higher and higher. We'll come on to that in a minute. The other info in terms of stuff that is going on today, the Russia stuff is continuing to get talked about and talked about and talked about. We had the US allowing of US missiles to be fired into Russia. You also had Storm Shadow missiles, which are UK missiles. This is one of these things where, as a trader, you have to now quite quickly become a little bit of an expert on who makes missiles, what they're called, and who's given them to Ukraine, so that you know when they come up with whatever the next new name of a missile is, you know who supplied that and what the implications of that are. So, worth a quick little research on that, of who makes long-range missiles and what are they all called.
So, because they found the British one, that's going to be negative for them.
Well, the implication is this is now more wide-based, which means there's going to be more and more and more comments, because originally it was the US has said Ukraine can fire US missiles into Russia. Now a UK missile has been fired. The UK has neither denied nor confirmed that they have allowed this. So there is going to be further discussion and further talk and further rhetoric around this in relation to the UK, in relation to the US. We've also had Germany yesterday, we're pretty much like, we're not doing it, but it'd be well worth knowing what Germany could supply and what their missiles are called.
So if the missile turns up, then...
Yeah, precisely. As much as they said they won't, it doesn't stop the possibility, and that's then significant. What you've had so far today is more Russian-based commentary. US missile base in Poland, this leads to an increase in overall level of nuclear danger. So this is talking about a US missile base that's in Poland. Poland's obviously very close to Russia. And if you know much about European history, it's typically featured quite heavily in a lot of conflicts. It's kind of the gateway between the East and the West of Europe. You then get Poland Foreign Ministry spokesman says there's no nuclear missiles at that base and it's for a defence, not attack. You would assume they would say that, but I would assume that also the assertion that there are no nuclear missiles there is probably true. Russia threats regarding the base serve as an argument to strengthen Poland and NATO's air defences. So you can see then there's going to be talk around Poland, etc., etc. You know, something that you do want to be looking at. If you're highlighting information as well on a news feed, I would make sure you've got one box that has clear, basically Russia, Ukraine, Poland, UK, US highlighted in it. In particular, any missile that lands in Poland. We had one a couple of years back that accidentally got into Poland. It wasn't intended. It may even have come from Ukraine, but the fact that a missile hit Poland was a massive deal. And that was seen, you know, because you price in the possibility first rather than anything else. We've had similar reactions on like military aircraft that are in exercise, and one of them's crashed in like Syria. And the immediate response to that is, well, this could be, you know, a US plane has been shot down. That's an escalation. You don't know, but you get a trade like it is, like it's true, and then you look for the counter to that. So just bear that bit in mind. What you then got was the Kremlin's reported a Storm Shadow strike, and they've got no comment. It's quite interesting. The UK's gone, we're not commenting, and Russia's also said we're not commenting on it. There's a very noticeable difference in the rhetoric regarding the UK to what was regarding the US. But then what you also had, and I would very much go and get on Twitter, go and find whatever the Twitter account is, X account, that relates to Ukrainska Pravda. Pravda, incidentally, if anyone didn't know, possibly didn't, Pravda is the sort of state-backed newspaper / news company, originally of the Bolshevik Revolution in Russia in the early 1900s, but is still considered sort of, you know, this main sort of state-backed media, even if it's not necessarily anymore in Russia. I think it's RIA now in Russia, but Pravda was originally, so worth looking that one up on Twitter, because this came out before 9/24. So what you'd often get is the Newswires then report this after, based on what they've seen on Twitter. They'll typically try and verify it rather than just post it. But yeah, Ukraine media outlet cites anonymous source saying that RS-26 ballistic missile was used to hit the city of Dnipro. So that is a ICBM, which is an intercontinental ballistic missile. That would be the type of missile used if a nuclear bomb was to be fired. It would be fired on an ICBM. So again, the implication of that is significant. Right, so there we go. That's where we are. I thought I'd do very quick go through what's going on market-wise. S&P, cash, non-cash. Cash session, interestingly, yesterday, you've got, for those who like a candlestick pattern, hanging man. The only problem with that hanging man candle is that it's in the middle of a range. If that was at the top, that would be considered quite a bearish candle. The fact that it's just inside the previous day is not particularly significant. These are also days, I wouldn't put much weight on the fact that yesterday was an inside day because of how big the range is. The point of an inside day is it implies compression of positions. There's no way you can look at yesterday and go, oh yeah, people definitely got very compressed yesterday. Yesterday was pretty wild and free moving. It was not compressed. So whilst you can get sucked in by the hanging man candle, I don't think the significance of that is too much. What we've seen in the last 3 days is progressive move higher, wicks to the downside, reasonable ranges still, reasonable volume still. It's all looking all right. If anything, actually, cash session, the volume yesterday was higher on that move down and rejection. So high volume rejection is a good sign towards the upside. What I've got there then for you is a 15-minute split session chart and profile. The one thing I'd say about yesterday, which probably was to a degree dealt with by NVIDIA, is if you look at yesterday's profile, this is what I call a disguised caught in the hole. Essentially, we dropped and traded here, and then it rips up and closes at the top. I'd look at that, I would not be surprised to see that type of move. You've got that on NVIDIA, which is slightly a problem, but you can often see this type of thing. You get this overnight roll back down on your sort of disguised caught in the hole trade. We've not got that. You got it for a period. So the thing you've got to weigh up here is whether that constituted the correction of this and it's done, or whether this very strong looking drift higher is actually justified and whether this could then roll over and go back down. We are now at a point where you are probably going to be opening nearly on a gap fill up at 66. So that's going to be the first thing to consider. Can it hold below the gap and then fill the gap back? Otherwise, we've got essentially gap up, gap down, gap up, which is quite an odd type of formation. I've struggled to find many examples of that, particularly with like a 5-day gap either side of this. So I would be leaning towards the fill back down here. If it stays above the gap though, so above that 66 area, bearing in mind where we are now, trading 70, if it does stay up inside here, and you're perhaps looking at so that kind of area, 76, before you can go, yeah, it's definitely inside, because this is a very late sort of drift down. If you get inside here, like inside the bulk of the ranges, then I think you do have the scope for that move up. Otherwise, any failure in this range here, I think you go at least and fill the gap down to there. That would be my sort of main sort of thesis, that you've got to work out from here whether it's going to stay up and move through the range, or whether it's going to fail, get back below 68, and then go for the gap fill.
If the Fed's going to hold in December, is that going to be a reason for a bit of a sell-off?
I'd worry about that in December. You've got, what, 5 weeks till the Fed? You've got CPI, you've got payrolls, you've got payrolls and CPI, you've got month end, you've got this whole Russia situation going on. There's so much information between now and the Fed that I would have. Well, I don't have zero view. My view is the same as it was previously. I don't currently see a reason for a change, as in a change away from what is already priced in. Which is a cut. You're 50-50 now, right?
Well, it was 70-30.
It was 70-30, yeah.
So it's kind of creeping.
It's creeping down, yes, but it was 60, then it went 70, now it's 50. You go back 2 months though, and this was 100, and then you were pricing for a cut. So this was not unchanged cut, this was cut 50, and it was split like that. It wasn't quite that strong, but it was like 60-30 for cut or cut 50. So, these things fluctuate wildly.
Is that, sorry, the one on the right is unchanged?
That's unchanged, 44%, cut
25.
55%. But yeah, like you say, you go back a week and it was 72, you go back a month and it was 64. Yeah, these things fluctuate around quite a lot. So I wouldn't, don't get too sucked in by it.
I mean, I start for jobs is enough for, like you said, get that rollover in the S&P and just, like,
I wouldn't read too much into the weekly jobs numbers. Yeah, they're weekly. The jobs numbers you care about is payrolls. That's the one that matters at the beginning of December. First Friday of December, that's the one that matters. I wouldn't worry too much about it. In jobless claims on a week by week basis, unless it is astoundingly out of line or has a sequence of weeks that buck the trend, up or down, whichever. Well, up would be more jobless claims, bad for the jobs market, more unemployment, that would be bad. But apart from that, I wouldn't read too much into it. Right. We'll perhaps intermittently come back onto the S&P in a minute. It's probably going to open pretty much bang on the gap. Right. The thing I wanted to do a bit on today, that was in the schedule, is think back to the Fed, quick debrief of the Fed. So I'll kind of talk through the way that I would go about debriefing a central bank and then also we'll do a day-to-day debrief tomorrow of what went on, how you would debrief that as well. So incidentally, the S&P's just opened and it is straight down. So you've opened on the gap and it is off to the races to the downside. And if you're looking for a short, that seems quite an obvious area that you've opened straight down. You've got all of this positioning overnight. If you can get below 61, that would be the point that I think sets up the move.
Which gap are you referring to? You mean
the cash session?
Hours?
No, the cash session gap.
Okay.
So you had that gap there. So it opened virtually at the gap and has then come straight off.
is that in itself like an overnight call in the hole type thing, Rich? Or?
Essentially, that's the essence of it. Yeah, you've got people who have bought this overnight.
Well, nothing really.
Yeah, but you can only see the gap through both the sessions, yeah? If
you can only see the gap if you look just at cash session.
Okay.
Because if you're looking at a full session, there isn't really a gap on that. So that's your full session. But if you look at the cash onlys, that's the bottom of the cash session, and then the next cash session is here. So that's the gap, which would be to there. And so it basically opened at the gap or just below the gap or just above the gap. It's come straight down, 61, churn some volume, straight back up. So, and this is the bit where, like I say, let it work itself out a bit here. Yeah, you've had a pretty wild couple of days in this. I'm not convinced as to which it really wants to do just at the moment, so let it work itself out. Be clear on what you want to do though. What I don't want to say is, because yesterday was a pretty wild day, be put off doing something early. If the opportunity's there today and you think that there's something clear, go for it. But equally, if you don't think there's anything clear, you don't need to get involved. I think yesterday was point proven on that. Yeah, pretty wild start, the S&P there. It's traded 68, 60, back to 68. So I have to see where it goes from there. And now you get the bunds back up towards that 50 area again. Right, anyway. The way that I go about doing a Fed debrief, and actually I need to, you can do it as a prep or not, but we'll stick to debrief. What I do on a Fed debrief is I use Evernote. I've always used Evernote. I know people who use various different programs. Evernote's great, apart from it's not that searchable. That's the only problem with Evernote. You can search it by typing terms in, but you need to know what you're looking for. Obviously, you're the one who wrote it, so chances are you're going to know, or you know the wording that you're going to use. I believe that it now has a bit of an AI feature, which probably makes it a little bit easier to find different things. What Evernote does annoyingly like doing is constantly getting you to try and upgrade to stuff. It's annoying. I would suggest, and I would say as people, use the free version to start with, and if you get to a point where it won't let you upload any more charts, it won't let you create any new books, then pay for it. Yeah, that's often the way of any kind of cloud-based stuff, that you have to do it like that. So do that. What I then do with each Fed, create a new note in my Fed notebook. I've got various different notebooks all along with all sorts of different things. So Fed notebook, create a new note. One of the most important things to do is put the date on it for obvious reasons, but also just give it a description. The reason I say that is it makes it a lot easier to remember, right? If you come back to this and you're thinking, well, what was that one? Obviously, you know it's going to be post-election, but what was that one that didn't really say much, but you actually got quite a distinct move in it? Or what was the one when he went back on the 75 basis point rate hike idea? If you've actually described it, you'll find that a lot easier than going back and guessing through dates and go, oh, maybe it was that one, maybe it was that one, maybe it was that one, that one. Go back and do it like that. It makes your life a lot easier. So that's point one. Give it a name. I just put it was 7th November, more than expected. It was day after the election, you'd have bad payrolls, but it was more than expected, so I put that twice on there. The other thing that I do, think about how this is going to help you in future. And the way that this is going to help you in future, let's not increase the size or anything. The way this is going to help you in future is by giving yourself an understanding of context. What I mean by that is if you haven't written a bit of context on this, you might look at the data, the hard facts, and misinterpret the significance of them or not understand why you've moved in a certain way. So get a bit of context down. Trump walked the elections, equities and cryptos are strong, bonds and gold dropping and dollar strength, and then the assumptions around Trump. Lots of data before the December decision. So, and always think in terms of implications. You don't need to explain what the significance of lots of data before the DEC decision means. You know what that means. If you don't, just explain it. But, in future, I'm going to look at that and think, okay, well, that means it's an easy one to not say anything because they can lean on we're going to have much more information come December. Some doubt on the November cut. Bad payrolls now with that on. You got the bad payrolls on the Friday. Once you got that, anything that it was already leaning towards a cut for November anyway, the bad payrolls just bang, 100% chance it's going to be a cut. And get down your expectations as well. That's always key, again, in terms of understanding what the reaction was. What the market expects is going to dictate what the reaction is. So you're looking for another 25 basis point cut. Put down what the pricing is also showing. You could whip the graph off FedWatch, or I quite like just the table, but display it however you want. When it's December, I'm going to have a dots one in this. There you go. Get the dots in there of what it was like. Any information that you think is relevant. One thing you can do is start the December one now, and any relevant information that comes in, just start accumulating it. Any comments from any Fed speakers, just drop them in. That way, let me just turn that aircon off. That way you've got all the information that you want. Dan, that bun's gone for the highs now.
I think it might be going up now.
That's easy to say when you're trading the high of the day.
I mean, I'm just on the daily perspective, that 56 is kind of out of that range now. The wicks always were above the 56, we close above. We can put a body outside the 56 now, but it'll be interesting.
We'll see. Right, so get down policy expectations. So this again sets the tone for what happens on the day, so that in future when you see 25 basis point cut and no movement, you know why the market hasn't moved on a 25 basis point cut, to make sure that you know that bit. The other bit, in terms of anything you expect to change on language as well. So that again, like I say, it helps explain the future, but it also helps you in your prep. You can use your debrief essentially as your prep and just get it all in one sheet and go, right, this is the Fed. I'm going to prep for it. So what you're expecting, where you're going to be looking, what you're going to trade. You can even go down and write down what your potential trades are. List out your trades or the things that you think are going to be worth trading. List those out.
And are we doing this on the day of the meeting, or are we updating it between meetings?
Like I say, you could start the December one now and just update it. So use it as an info collection, and then and then on the day before, what are the expectations? What's the language, or what language change are you expecting? What do you expect the dots to be? What do you think is going to come up in the Q&A? And you will have all the information before that for you to understand why those types of questions are going to be asked. Incidentally, the S&P's just done what it did yesterday.
Huge move,
Yeah, it's just absolutely fallen out of the sky.
Bipolar.
Huh?
Bipolar.
Yeah, that's absolutely nuts. Again, same move as yesterday.
You don't know what it's doing.
Exactly. Go back to the lesson from yesterday. I think what the S&P has done there is done that bananas drop. The highs from yesterday and the day before are now back in play as your resistance. The top of value from yesterday's support possibly fall further into that, but it does look like one where it's just trying to fill out the value again, like it did yesterday. But you definitely at a point now where you want to get involved on the open, and this is a pattern. Tomorrow, if it starts to go on the open for the sell-off, I'd sell it and go for, go aiming for the big move. Right, well, you could have done that today. Yeah, it did exactly the same as yesterday. It opened, it went up and down a little range, and as soon as it broke the bottom of that range, it went. Which, if you were playing for that closed gap anyway, it's done it, straight down, now it starts to balance. What you'd expect is on the back of yesterday that the bounce will probably be a bit quicker because everyone knows the game now. You saw it yesterday. If you think it's going to bounce, you might get this sort of quicker bounce and it will start to build out faster because everyone knows the game. Right, so we've got our expectations. You've got the sort of chart to support that. Again, if you do this every time, you will have the chart, and you could even do this on a weekly basis, put the chart up every week so you see the progression of the expectations of rates if you want, or even just do it as a table and do weeks till the Fed, T minus 1, 2, 3, 4, 5, etc. And then what the pricing is rather than you have image, which is going to be hard to sort of decipher and work your way through. So if you just plot them in a table week on week, you get a better sense of it anyway. Right, so what you're looking for is a change. The whole point again of a lot of this is, even if you're not going to trade it, even if you don't really know what the implication of moving or changing the confidence line means, you're building up a sense of what is being talked about, what is significant. You start to see it through the lens of the importance of that line rather than looking at it after the action and trying to piece together why it moved on different things and pinning your version to it. Q&A, the Q&A is, and I'd always put down what you think would be important questions. Essentially, what are the questions you want answered if you were there? Chances are someone will ask a question reasonably similar to a question you want answered anyway. So what it also does is focuses your sort of idea generation of what you want to do. You can look at it and go, well, I want to know whether they could skip in December. I want to know whether they could still do 50 basis points, whether the terminal rate will be as low as it was previously expected, i.e. are the dots actually correct anymore? So they're the questions that you want to look at. A lot of debriefs is down to just getting information down that could help you out in the future. The big takeaway from this one for me on this bit, there you go, was that on Reuters, what has come out, so I got the things that I'd highlighted, the somewhat elevated, which was their reference on inflation. I hadn't highlighted anything on confidence, but what they did, and I'm quite glad I didn't, because, well, you would have seen it, but then thought, oh, well, there's no change there. Reuters has put the statement omits the reference to having gained greater confidence. So that then becomes something to highlight next time, the use of omits. So if they drop a line, that's the word to then start looking for in future, rather than looking for drops or removes or whatever other variation of that word you can think of. So that would be my sort of key takeaway. The other thing I'm always looking at is the time. Is there any, have they changed in terms of, is it slightly before, slightly after the hour, so that you're not sort of switching off. If it's come out 5 seconds after the turn of the hour, you don't get to 7 o'clock and start looking around going, oh wait, what's going on? You still need to focus. Or you will have some that come out slightly ahead as well. You need to be watching those. It's a really odd move. So I just saw the Bund again. It's gone through the high and it just rips down the page again. So yeah, it's quite the one for trading. Russia did not use an ICBM to strike Ukraine on Thursday, a Western office tells Reuters, citing initial analysis. Okay, so there you go. That's part of the reason for that one. So they thought it was an ICBM. It's not an ICBM. Fine, but there is still an element of they did still fire on them.
Yeah.
On that Pravda, they say Russia conducts first ICBM strike on.
Yeah, so one thing to take from that is take that with a pinch of salt in future. Bearing in mind, that is Ukrainian state-backed media. They are always going to have a anti-Russia slant to it.
I thought
So,
that was Russian government.
No.
Okay, yeah.
but Pravda is the state-backed media company. Bearing in mind, Ukraine used to be part of USSR. go and read some Russian history. So it's interesting. They're going to have a lot of similar terminology. You know, their languages are pretty similar as far as I'm aware. Right. So as I said, a lot of debriefing is about getting information down that's going to help you in future. It just provides you, effectively like a warm-up for next time, that you can see where things happen, what happened. You can start to plan out what you would do in similar types of situations. From a language perspective, I'd always get in the Wall Street Journal Fed tracker. If you don't do that before the next meeting, this will update and you won't see it again. So wherever you store your data, wherever you track things, debrief stuff, make sure you get that done, because if you don't put that in, you won't see it again and you'll be really annoyed in future.
What do you mean? You have to take a screenshot.
Yeah,
okay.
yeah, Wall Street Journal Fed tracker. If you just Google that, it brings up, what it does is it shows you the statement. The things that are in pink have been removed from the previous statement. The things that are in green are new in this statement. And then anything non-highlighted is exactly the same as previous. So that's what it shows you. So basically the new statement is all of the non-highlighted with a green background.
And do you get this on Wall Street Journal?
Yeah.
Okay.
Yeah. And anything with pink is white background, and pink is the old statement, white background and green is the new statement. Just allows you to sort of see what's changed, where the sort of significant shifts are. So labour market conditions have generally eased. So rather than job gains have been slow, labour market conditions have generally eased. That was a change. Inflation, and this was what you were trying to do as well, is piece together why you got the reaction and whether this was worth trading, which I've put in a little bit in the write-up afterwards. Inflation has made further progress is dropped. Inflation has made progress towards. So I mentioned this in the prep, that it's these little subtle shifts that by saying that they're starting to move in that type of direction. They've dropped the gained greater confidence and they just judge that the risks to employment inflation are now in balance. So they're not gaining greater confidence that they're in balance, they just are now. So it's all a step in one direction. It's a slightly hawkish step. Nothing really changes in the rest of it, so there's no guidance change. So this is a sort of nuanced stepping in a certain direction type of movement. The next bit's the press conference. What I would try and do, I put the link in just so you can go and find the previous press conference manuscript. What you want to be looking at, or what you want to try and do, is just list out the rough description of the questions that were asked. You don't need to go back through the transcript. Again, make sure that you're always doing this from the perspective of you're just trying to increase your understanding of something here. This doesn't have to be beautifully presented. You don't have to have the questions word for word, anything like that. I also put down, if relevant, who asked the question. Yeah, this is the Timoros question. This was the first one. Incidentally, if you didn't know, Timoros is the main sort of Fed commentator on Wall Street Journal. He's sort of the main man. Him and Steve Leisman are the two that you want to watch on a Fed decision. So if you get a sense that there are certain people who get the big question, they're the people to watch out for. Also, worth looking at what they look like. So if you're watching the presser, you can be like, oh, I know who it is if you didn't hear the name.
What was the second guy's name?
Nick Timoros from Wall Street Journal and Steve Leisman from CNBC. He's a big chap with bald head. Anyway, so the questions were, essentially the question was, how do they interpret the higher yields that are currently out there? This was the one that seemed to get reaction. It was the two Timoros questions that got, the two Timoros questions got reaction. Interpretation of high yields, and what was the key bit to that? And then, are the dots still valid? I thought that he kind of dodged this question, personally, from the way he answered it, and then he answered it better later on. So you'll often get variations of the question. So the Timoros one was, are the dots still valid? To which he says, activity has been stronger, overall takeaway is the sense of downside risks to activity have diminished, job report wasn't terrible, we'll make a decision on rates as we get to December. So he doesn't say that the dots are wrong, but he doesn't really give too much answer to it. Nevertheless, the accumulation of these two, you start to get the sell-off on it. There's quite a quick sort of reaction, particularly that the rates are no longer based on higher inflation expectations. So that goes, okay, well, if it's not inflation then, this is pricing in less rate cuts, reflecting growth as well. If you think the economy is going to grow, then you perhaps don't need that many rate cuts. So that's the way it's been taken. It's got this kind of hawkish run away from the rate cuts type idea. But S&P's done that technically rather nicely, hasn't it? Perhaps today's the day for the super technicals. So we're going to trade 45 and then all the way back down again. Possibly. Right. The next bit, or the next significant question, you don't also feel you've got to list out every single question, every single response. You know, if you've traded it, you're going to know what happened, and you'll have that sense of, you know, the way the questions came out, how much the market was really moving on it. Is the 1% cut in 2025 still a valid idea? This was the other variation of the question. You know, if you go back to what are you trying to find out, one of the things you're trying to find out is where's the terminal rate going to be, i.e. how low will they go next year? Doesn't answer it there. Is 1% cut in 2025 still a valid idea? Not ruling it out or in. And that was taken much more to be, well, if he's not going to rule it out, then 1% is still on the table. Yes, he's not ruling it in, but the market's already pricing that anyway. So that then gets the view that, well, it could still happen, that they're at least entertaining the idea. Ultimately, it was going to be one of those where the reaction to this is much more, and this is why it goes back to your current pricing idea, the reaction to this is much more to do with the fact the market was pricing out this idea, and then it's deemed dovish because he's at least acknowledged the possibility that it could still happen. So then it kind of prices it back in on the basis that you can't price anything further out if it's still possible. So that's the idea around that. That was it as far as I was concerned for questions. What I would then put is generally a quick summary of what the overall take of it was. Dovish, more than expected in terms of movement. You know, going into this, I had zero expectation of anything really. I thought it was going to be a very, very muted one. No changing guidance, not ruling out market price for 2025. It was a shorter press conference as well, something else to be aware of, that this only lasted 45 minutes. Typically it'll go to an hour on these. This could be a feature, and this is, you know, a new feature that just gets it done in 45 minutes. The upside of that is you're probably going to get, if there's anything, it's going to come early. So it almost shortens the window of activity, but direct or sort of concentrates it probably onto the first one or two questions, which is ideal. That's kind of what you want. You want clean sequence of information. If he's going to do it like that, brilliant. In terms of the actual distinct parts of it, you got the initial hawkish reaction on stronger growth and the data callers in yield rises. Long end led reversal on the not ruling out 2025 cuts. That was a more subtle move. That was the only thing to sort of really sort of take away from this, that what you got with this one is that was the initial hawkish move. No matter which bond you look at, they all have this initial whip down. Then you get that first question move, and then you get that much more sort of subtle 25 basis points, sorry, not 25 basis points, 2025 comment, and that gets this much more sort of subtle reverse. What you're trying to look at is, well, how would you go about playing any of these things? And you know, you don't have to kind of try and write it all out. But if you've got that, you then sort of go, okay, well, what would I do here? What was viable? And that's what you're also trying to do when you're going back through any of these types of things. Go, well, yes, it moved down on that first move, on the drop of greater confidence. Is this actually a trade that you should be trying to take on? Or is this a quick move that you kind of wish you were on? Yeah, so what you're going to try and do is assess this from the perspective of viability. You know, was this really that viable, or was it just a quick move? You know, from seeing what happened, a few people hit that. It wasn't an across the board, bang, everyone hit it. This is dead simple, straight line, smash it. This is much more a few people went for it and they got a few ticks, and a fair few of them got caught out when it started to bounce. Sorry, not when it started to bounce. It started to bounce back. The bonds as well stayed down to start with. So again, the other thing you're trying to always take from these when you're setting up the future Fed decisions is, if you do go for that as a trade, the bonds don't reverse straight away, which means that you do have at least a little bit more safety, that it's not going to just go, oh, filled, bang, back in your face. Whereas the S&P did exactly that. The 2 years consistently the biggest mover on it as well. So that's the other thing you're trying to take away from it. So one way to do this is just do a little bit more of a write-up on it, you know, a description of not just the where it went and what went on, but how it actually moved. Because that first move was swift, and if you can't remember, just go and replay it. Replay like literally the first 5 minutes, and then replay it from 7:35, and that move there, if you can't remember. And rather than just write, oh look, it went from here to here, you can see that on the chart. what was it like? How viable was it to get in? And then how did it move? So that then in future, you kind of get a sense of, okay, well, I've seen this type of thing before. You hit it, it goes, and then it does this, just it sticks at the low. And that's then the point where essentially it sits at the low because everyone's waiting for the next bit of information. They're waiting to see if he's got any more than this or whether this is it, essentially. So you get that, and then you get this bounce back in the bonds. It's also a long end led bounce as well. So that's the other thing just to be aware of. This is why people go the 5 year, because if it's long end led, it will still follow them. If it's short end led, it will still follow that end. Whereas if you go to the extreme, the 2 year doesn't bounce that well. So if you're trying to play the 2 year, you don't get much. Long end led sounds nice and easy, apart from the fact if you're trading the 30 year, why do you know that this is the leader? You don't. So unless you're playing this with the view that this is going to go way through the original move, you're probably not capturing that. So at least then, you know, that's again a reason to look at the 5 and 10, because at the extremes you're going to get one end or the other leads. These two are then going to kind of, you sort of know which one you're following. You know where you want to be looking. That's then the equities.
Sorry, wait, so the shorter end is not guaranteed to lead in the Fed rate decision? So,
No, not necessarily.
Sorry, it's just like a bloody disco or something on that side.
Oh yeah, it's all go. No, the short end doesn't have to lead. If it's a policy change, the short end is generally going to be the more significant mover, but it doesn't have to lead. And then what you get on the more nuanced bits of it, the bounce back, for example, then you're trying to work out who is leading that. You know, my take on this over the following days, I'll come to in a minute actually. The other takeaway is the euro and the S&P don't really seem too bothered by it. You know, the first move, the S&P is an absolute no-go. That's just a complete chop about. The hawkish initial comment, it drops not particularly far. It essentially just stays in a range and then starts to drift up. Gold has still got some decent movement in it, at least on that reversal. And so gold then starts to follow the long end on this one. Gold's quite skittish as to what it follows, but it will sort of pick up on one of them. Generally, gold follows the more direct mover, whichever one that is. The euro, much like the S&P, didn't do a great deal on it, so it then helps you sort of understand where you want to go. The other thing to sort of add to that is, and I put this in my notes somewhere, I can't remember where I put it. It might come up in a moment. The two real big movers post-election were the S&P and the euro. S&P up, euro down. It almost felt like they were much more influenced by the election in this sense, that the S&P just wanted to go up. So it was always going to struggle to go down. The euro just wanted to go down, so it was always struggling to go up. Whereas if you look at what happens in the days after, which I've got here, it's always worth doing. Get the days after the Fed. So the Fed comes in here, comes in here, and comes in here. You look at the days after, and everything basically just got on with what it was doing. At least the not what I'll call non-bonds did. The euro just keeps on dropping. Gold follows the euro. S&P keeps on drifting up, and then what you got after that in the treasuries is essentially they just reversed the election move across all of them, and then the 2 year goes down and the long end stays up. So what that suggests to you from a correlation perspective, the 2 years going down, pricing in less rate cuts, the long end stays up. So the reason for buying the long end whilst you've got less rate cuts, which could be in inflation or could be in reaction to inflation, that's a kind of stagflation move, that the expectation is growth may struggle, rates are still, well, they're not going up, they're not going to go down as quickly as you thought. That would be my kind of take on that.
You're going to get higher interest on your yields.
In 2 years, but not in long end. People are buying the long end, or at least initially here, they're buying the long end.
They're going to think inflation's going to go down.
Well, they think that growth's going to struggle. So you're going to have inflation staying up, raise rates, / don't cut rates, economy not doing too well, buy bonds. It's almost a precursor to the equity sell-off. That sort of curve curve flattening inversion type move was almost a precursor to the equity sell-off that was suggesting stagflation. So yeah, I would then get a bit of a write-up. You could do this a week after, any point afterwards. Quick write-up on what then happened after that. Bonds bounced from the election, longer end, stronger short end reverse, price less cuts but less growth, so stagflation, dollar strength, gold weakness, and equities waiting for the next move, which essentially they waited and then seemed to take account of this and rolled over. What I'd then do underneath this is where you can then go through what could you actually do on it. What were your trades? One trade you actually took, so go through the trades that you actually did. That's your own analysis of the trades you did. Were they worth doing? Did you interpret it correctly? How did you execute it? How did the trade turn out? And then also try and split the trades up between, you had the initial reaction trade. Now, whether you traded that or not, was there a trade in this? So this is then also being able to try and look at, well, what types of trades can you do in these types of events? Remember, a debrief, a lot is there to try and learn from. If anything, it's just going to learn or teach you something. You're trying to understand, well, what could you do in these situations in future? Was it really a missed opportunity? Was it not? The first question, that's consistently the thing. Typically, you have this window on the Fed. Once he's finished his sort of elaborated statement, you get a period from about 7:35 till 7:40 is usually where you get the move. So if there's going to be anything distinct, it's typically the first question. And that was the higher growth implication for rates question. So, and the other thing on that I'm just trying to note down as well, the bonds seem first to react. The non-bonds are about 30 seconds later. Like the candle had turned before the non-bonds really started to move. And it was the bonds started to go, then the non-bonds moved. And then what I'd call the sort of flow move, the move that comes afterwards, the sort of nuanced part of it. Which is then that bit about the not ruling out a cut for the rest of the year, and then the kind of basically the take that, well, if they won't rule it out, this is a chance to buy. My overall sort of take on the whole thing here was, this is very much and you could try and categorize these, that could be another feature to bring in, just categorize the type of Fed it was. This is very much an interpretation and technical Fed in my view. What you ended up with was a situation where markets didn't really do anything new, and if you looked at this without knowing it's the Fed, you had some pretty clear opportunities. And I think that's an important takeaway, in that you will often have these and people try so hard to interpret every last bit of it rather than look at it and go, unless this is significantly out of line and significantly changes my view on anything, if this rolls down to an area of support, expect a bounce. If it rolls up some resistance, expect a drop, and trade it like that, rather than feeling that you've got to trade off every comment and every interpretation of everything that's happened. I'll share this with you guys. I'll send the link so you've got a kind of template one. One thing to also say on this is these things change and vary all the time. So they will evolve. This was the one that I'd done for September. I could share this one as well. And it's perhaps got a slightly different structure to it. I had previously done sort of a more, so you could copy and paste the structure. So I'll send that if you want to do it like that. The more and more I've done that, the more and more I find it can get a little bit onerous to copy and paste and try and fill it all in. But I've done that for the changes in rates and how they've changed. I think you're probably better if you're going to table something, just create a spreadsheet and do it all like that. That way it's easier to search and easier to compare all of them in sequence rather than otherwise. I don't know if I've got the, no, there you go. And any other charts that are useful. Don't fear just whacking charts in. If you get the charts in, you get the information there, it may be helpful in future. Think of it like that. That at some point, if this pays you in the future for whatever reason, it was worth doing. This one, for example, this was what I call the forced 75 basis point hike. Again, I can share this one. I got that bit more similar to the one that we've just done, with a few different variations in it. So again, I can post all of these for you as well in terms of the way everything moved on it. That's a much more extreme move. If you go and look at, say, the S&P on this one, that move there where he backs off, where he backed away from the 75 basis points, the S&P goes 110 handles on that comment. So, you know, that gives you a sense as to the significance of some of these compared to others. You know, that was the time when, you know, the market was really, really careful about everything that was said. You know, gold was doing some pretty wild stuff on this as well. You know, that was the that was the move on it, and you know, gold does 250 ticks on it. So there's some huge moves to be had in some of these in the past. So I'll share all of those just so you've got these for a bit of variation on the way these things come out. It's well worth doing, just so that you know, and like I said, don't fear just putting charts in. As long as you're quite consistent in the way you put them in, it just aids you in future to be able to look back and go, okay, well, they all, certain markets react in certain ways to each of these types of things. I'll show you day-to-day debrief tomorrow, and we'll debrief the action of yesterday and how things played out. So yeah, I will send all of those on Scrimey. Pretty much covered everything was discussed today, so I thought I'd bring back the S&P as to where we are now, and this is just all over the place at the minute. I think you've got to look at this at the moment that, well, once again, you're still inside the IB. It's on a pretty wild ride at the moment. I think it.
What's the offers and sorry, I think does it seem thin or?
Sorry?
Does it seem thin on the order book?
Yes, yeah, it's definitely thinned out, but that's what you'd expect. Like whenever you get sort of much faster movements, I'd always expect it to thin out, because let's say you've got to trade, you know, 50, you could split that across two prices because you're going to get filled that much easier. If you go trade 100, you can spread that out now rather than trying to, when it's not moving so much, you have to go all at one price to make sure you get filled. At the moment, this is just washing through prices. So if you want to sell 100, you just go 20, 20, 20, 20 in a line and you'll get them. Whereas when it's much slower, you can't do that because it won't trade through you and it won't trade, yeah, it's not moving enough. Yeah, where you are at the moment, we are just, you're kind of middle of nowhere at this point in time. So this would be the one where you kind of sort of step it back a little bit and go, right, well, we don't need to do too much. It's gone down to lows again, it's tipped the low and it comes straight the way back up. So yeah, this is clearly showing you, as much as it had that ferocity on that move down initially, it doesn't really sort of have the continuation of that. And overall, you're seeing generally the delta's winding up. Yeah, delta didn't really drop on that move down. You look through that whole move down, you didn't get much drop in delta, and then on the move up, you get this much more aggressive buying. Same again here, it's not so distinct here, but we are on the way back up, and you've got this more sort of steady bid about it. So yeah, you just try to build, you know, piece these things together. Like I said, we're a long way from the end of the day at the moment. We're not even at the end of the IB yet. Again, I'd expect the IB to break. Which side it would go, I would still lean on the back, well, depending upon where the IB closes, but on the back of the open here and drive down, you would assume it would break the low. I know that was disproved yesterday, but it was only disproved on that final wash up at the end of the day. So I'd still lean towards that. You're back inside this range as well. So that's another reason to then think, well, is there much justification for really going further towards the upside? You know, if it was going to stay above the gap, surely it should have done that, and it didn't. So that would be a reason to think, well, there's potential downside in this.
I think it might still work too.
But it is one where, and the other takeaway from yesterday, and probably you'll see this as well today, is that whilst I think, yes, it will probably take the low, it's probably not going to do that in a straight line. As in, if you sell it up here and you got the 45s, for example, it doesn't necessarily have to straight line the low. As in, you could see it now come back down somewhere in here, back up, and then the low, or back up, halfway back, and it was, yeah, because we are in this stage where this is in a non-directional market now. It's what you call a two-way auction. So if it's auction in both directions, it's not going to just straight line one way now. It's going to go up and down, up and down, up and down, and you've got to let it do that. So this is then probably more leaning towards your scalping type of traders, where you can go, okay, well, if I'm selling 45, I can play it down to perhaps this area in the mid 30s, and then you give that one up. What you just got to be clear on if you're doing that is where you're buying and selling. What I wouldn't want to be doing is cutting and reversing long in the mid 30s. You're too much bang in the middle of the range and you run the risk it could go anywhere. You know, you could cut and reverse long and that is the one that goes through the low. So, you know, be quite sort of quite clear on which direct or what is an exit versus what's an entry. You know, if you're buying it, some kind of failure down here, you know, an inability of Delta to go lower, ping back through the current low after a little dip could be a decent buy. But I wouldn't want to be buying mid 30s here.
Not after the last couple of days.
Well, it's not even that, it's generally on any day. Any day that the market has traded up, down, through the 30s, back through the 30s, through the 30s, back through the 30s, you don't want to be long or short in the middle of that. You want to be short at the moment towards the top of the range, which you've got good justification for at the top of this sort of 3-4 day range. And you want to be long at the bottom of the range until it drives through, on the basis that this is unlikely, with the size of the IB again, to be a huge directional day now. So movement just through that low, 15s again, could be quite a decent level. Double O from yesterday would seem a reasonably sensible place to have a go at. They would be the areas you'd be looking towards. When it does this is where you also don't want to get yourself sucked in. Yes, it's chopping around. Yes, it's moving quite freely up and down 3-4 handles here. Don't want to get myself sucked into this, because whilst yes, maybe you can sell 38 and get out 35, it's the middle of the range. So at some point you sell 38 and before you know it, it's trading 45 and you've given all of that up. So you're not playing to the strengths of the market at this point in time. You're playing to your desire to be involved because it is moving up and down and you think there's a few ticks to be had. Yes, there's a few ticks to be had.
There's more ticks to be lost if it reaches there.
Well, yeah, it's a dangerous place to be picking up ticks. It's picking up pennies in front of a steam train, or steamroller as it's referred to.
That's a good way to look at it.
It's a bad description. Yeah, I still think if you can get the 47s up there, little break of this high, 47s, stop above the recent high at 50, that would seem a sensible attempt then for a bit of a move back down, and you can start then looking towards the mid 30s again, and that becomes your potential trade. Once you've got yourself positioned, I explained this a little bit more yesterday, but once you've got yourself a position, particularly if you can get in towards the edges of these ranges, then you've got something to work with and something to sort of trade around. Particularly if you feel like you've got the top of the bounce, then having that position gives you then the chance that you can sort of try and trade that down the range as the move goes. But yeah, don't feel that you have to be overly involved just yet. Let it sort of play out. But the good things at the moment now is it probably told you what it's going to end up like. Yeah, I think you could, within reason, draw the profile for the rest of the day now. My expectation would be, yeah, it might extend lower. Yeah, I wouldn't be surprised if it bleeds down here. Maybe it gets up into this like mid 50s, but I wouldn't expect much more than that. And it just rotate. I don't know where the close will be, but it'll be inside value. So if value is somewhere, probably not far off where it is now, between 50 and 20, somewhere in the middle of that, I'd expect it to close, unless it does something wild at the end of the day. Yeah, if you're still here at 8:30 tonight and it starts to truck its way up, don't rule out the play for the high trade and repeat of yesterday, but I wouldn't expect that to be the move. That's more sort of something that's waiting. If it becomes an opportunity, you can play for it.
Got to work tonight, unfortunately.
So now it's just broken that little low at 35. If you really want to have a go in the middle of the range, you can have a go at trying to sell it. The little flick back towards 35, if it can stay below there, then you can have a go at the next leg down this range. You start looking down towards sort of the mid 20s and play it like that. So there you go, you're starting to get a little bit of movement. I still wouldn't be looking at it thinking, oh, it's going to go through the low, yeah, this is it, it's all over. But you saw a few of these yesterday where it would do this kind of thing. You had this little pulse down, and you just got to try and work out where you think this is trying to stall. You know, is that 28 and a half? That could be the point where it starts to stall. You give it up around there. When you're sort of trying to scalp something like this, though, don't get panicked if this goes tick, 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 32 again, because that's where you then go, oh no, get out of 32, and then it trades 26, and then you chase it, and you're constantly sort of taking like 2-tick winners, and you're not extracting the bigger movements. Yeah, at this point, we've just had this rush down, so I'm now looking at this thinking, okay, well, it's sort of set its stall out at least for the interim period. Maybe, yes, we could have gone for a little bit more on that. Well, that's another reason why you should try, if you can, to get a bit more size on some trades. Because if you got 2 on that, then you could have got one out when it started to stall in the high 20s, and then had a go at then trying to hold the other bit. Yeah, I think that's quite a reasonable target to get down here. That's where a lot of the congestion is on the day so far. So you don't have to think it must go through the low, and that's quite important about a day like this. Like I said, if it's going to break the low, it doesn't have to do it this time. It could do it after it's gone all the way back to 50 again. So it's much more now about sort of just taking the bits that you can take out of it and trading it around like that, rather than trying to extract everything out of it. So then back up we go, 25s. I'd still be looking at this thinking somewhere around 35 now. You could have a range within a range here, and it sort of rushes back 35s and you can trade on that. Or even 26. So if you really want to play for the low, you could look at it from sort of 26-ish and see that as your kind of quick pullback. I'm not convinced of that. I'm more trying to illustrate an idea than actually really believe that's going to go. So the difficulty with that, if you don't get out at say 28.5, it's suddenly trading 32, and then you're thinking, well, should I sell more? So that's why you've always got to sort of weigh up, like, if this starts to go wrong, you don't want to get out at the next resistance, which is also a reason why you don't want to get too involved right in the middle of a range. But if you're trading this now, you've got to be looking for 21 at least. You know, you want to see that 1 minute candle at least get down here, see if it goes through 21, see if it can actually start to then send the delta down, because you've had that quite significant ping back in delta here. So you're 21, just like I say, by getting involved, you get a better sense of what's going on. So it did hold 26, it's now holding 22. Delta's ticking up again, so it starts to look a little bit shakier.
It's the way it traded that last rotation high, and the way the other markets are holding
Back
up.
into this
Do you
area.
feel we may close high today?
That what?
We may close high today?
The close is 6 hours away. I have no interest in even trying to guess that. Yeah, if I can sell 26 and get out at 18 3 times today, that's far better than worrying about where it's going to close. Because where it's going to close, there's no real relevance. Like if I know where it's going to close, it doesn't tell me how it's going to get there. Right, so there you go. Now we're through the 21. Does it go for the lows again? Or is it going to get stuck at 21 here? So you go 18s. Yeah, like I said, I think 15.5 is a decent level. I wouldn't be too precious about it. It must go 15 because it's already struggled down here. So if it's going to struggle here again, I don't want to sit here going, oh no, it's got to go, it's got to go, it's got to go. If it flicks through, wonderful. Is it going to do 15.5? That's annoying. But again, I wouldn't be too precious about trying to, hold and hold. I'm not going to try and hold that for half a tick when you're right at the point. If this is going to bounce anywhere, it's probably there.
Especially with S&P, you've got to be quick, you can't.
But there you go, it's bounced back. This is exactly the area that if you want to now try and play this up, you could. You're getting pretty close to the IB close as well. So the fact that you're going to close the IB probably very close to the lows, you would assume it's going to have another shot at it, which would be a reason that I don't really want to be trying to buy it yet. As much as I think there probably is a buy in this, I'd prefer to see it go through and fail than I would to see it. So you see, there's definitely a willingness to trade here. It's quite a lot of volume done 16.25. So that then becomes a little bit of a reference to watch for. But we think you got a minute or so. Be interested to see where this gets to now. But yeah, you just watch for a little bit. You get a sense as to where it's moving, how it's moving, and whether there's a potential trade in it. We've got 2 minutes.
So it's still?
Sorry? Oh, a minute. So I'll run it till just on the IB and we'll see how it trades. But you can see it's definitely getting quite sticky down here. As much as it's sort of progressed a bit, it's not felt that easy at this point. And it's starting, it's been quite sticky. It's starting to get stretched away from value. This is where, as well, don't trade yesterday's battles. As much as you can look at this and go, oh, remember yesterday, I don't really want to buy this on the way down. This is slightly different in the way that it's trading. I don't think we've seen anything news-wise. It's slightly different in the way that it is trading, so I wouldn't be sort of too panicked about trying to buy it. Yesterday, as much as it looked like it was absolutely falling out of the sky, it did bounce. So I think there's probably a potential, but you have now just ticked through. So there's the new print on the IB. Gets through, that could be the one tick of the low. So if you are going to have a go at buying this, you'd be looking to have a little go at it down here. And you get left behind. But it's done, it's now fulfilled the break in the IB. And it's also extended the IB. It's traded the 8-9 area. This could be a chance where you could have a go at trying to buy 9s on the basis that it probably won't go back down there, or you at least get some degree of bounce. I'd look for it to, I'd be surprised if we get a single print today. Yeah, So I think you could probably get this at least back towards 18. And you've not got much of a stop on it. Yeah, I wouldn't be trying to hold this far below through the low, just to save that risk that, if this does go through the low, it could be very quick. So then you sort of, you try and buy nines. I don't like trying to buy lows. So I'd be very cautious. If it gets down here, I'd be out of that pretty fast. But you're using the P&L you've got. You've already taken sort of 18 handles out of it, something like that. Wanted to see it get through 13, 12, 13. If it can do that, then if you can do that and get back inside range up here, you could then start looking into the mid-20s again. So it's a way of trying to play it the other way. But you see it, this is the classic sort of battle of those trying to play continuation are trying to sell 12s. Those who are willing to buy it are just trying to accumulate it down here. So it's just buy, and then everyone's trying to sell 12s. If it gets over 12, you could get that rush up. If it doesn't, then the people who've been trying to buy it eventually give up, which is part of the reason why it can flush the lows. So you're in that, as Peter put it, you're in this kind of battle stage at this point in time. And of all the time of the day to have a look at this, we managed to pick the 3 minutes that it's gone nowhere. That's that's part of the thing with trying to buy a low. You try and buy low, you have to accept it's going to sit and sit and sit there for a while. It's going to make you uncomfortable because people have got to work out that this is a chance to buy. So there we go. So you're through the 12s now. I'll be looking 16 for a first entry. Oh, that's caught everyone.
Interesting. Just looking at the bond side of the bond. If it was to put in volume, I look at 56.
Yeah, this way I hate bet jigsaw. It pings your average price up there. In my head, I'm not long from 12 3/4. I'm long from 9. I gave up the 12s when they didn't work, but I'm long at 9.
Is it giving you the wrong average price?
No, it changes the average price based on where you get in and out of the trade. There you go, it's traded 9s again, back up. So see, but yeah, I think it will close the gap. The longer it stays down here and doesn't close it though, the more likely it's to go down. So this is a trade where it's time sensitive. If it can't start getting up and closing these single prints soon, it starts to build volume and it starts to look like a trend day. So it needs to go and fill those. Get up there towards 17.5. There we go, done. And then you can start looking at the next leg up. And if you can get above 18, get inside these single prints, you could then be on for the next leg towards the upside. I'd wait for a wash down before I play that. There you go. Right, I'll leave you guys to have a go at that anyway. I'll wrap it up there. I'll see you tomorrow. Debrief, I think we'll be doing at 11 o'clock tomorrow, so we'll do a little bit of debrief tomorrow and a little bit of prep for the week ahead as well. Catch you at 11. Have a good evening. See you then. Scalp around in the S&P. But it's great, once volatility picks up like this, the amount you can do with just a 1 minute chart and a banner.
Just with one market too, the S&P, you can.
Yeah, exactly. There is some value in terms of trying to learn something. Just switch everything else and just watch it like this. Like correlation is important. That you've got to think in stages of how you build up your skills. Trying to understand the nuance and completeness of correlated markets versus trying to understand how to trade some order flow and some short-term reactions and market movements. You can learn this much easier than you can assimilate correlations and news and all the rest of it.
I feel like for something so volatile, I need to lean on a bit of, something. But
I don't think you do. I think that's the temptation to think that there's a solution in trading it in a certain way. I don't think there is.
I think I've got to practice highly volatile market. Well, not even highly volatile, just something other than the bond. Yeah.
That's a quick bit of watching there. And that's nearly $2 grand.
I mean, what, a couple of lots of them?
That's the performance on those trades. You can take some losers, you're always going to get a few losers along the way. But you're taking a few winners as well. There's a couple of winner trades in there as well. You can steadily building up that.
Yeah, good day. I'll be happy with that. Takes me a month to make that.
Well, it doesn't matter. Wait, what? Boom, 530, sell 50. If you've done that 5 times today, that's grand, and you would have lost on one of them. So okay, even with one lot, you'd have made €600.
My plan is over Christmas I'm going to be doing 60 hours a week. I'm going to get up early and trade the bond.
So I wouldn't
December,
December trade until the control rollover.
till the
There you go, you're back above 18 now. This is game on now to go back towards 35, I think.
What's the, yes,
Yeah, you don't want to be trading over Christmas.
what date do you reckon, Rich? I'm
Rollover.
is it like, is it give me at least a couple of weeks of December? Or?
Well, rollover is the third Friday.